Expected family contribution, or EFC, is a critical concept in understanding college financial aid. It represents the amount the federal government calculates that your family can reasonably afford to pay toward 1 year of college expenses. This number plays a crucial role in determining your eligibility for financial assistance and affects how much aid colleges may offer you. Understanding EFC helps families plan effectively for the true cost of higher education. The expected family contribution is a specific dollar amount determined through a standardized federal formula. This calculation estimates how much financial resources your family has available to contribute toward college costs for one academic year. It is important to note that EFC is not necessarily the amount you will actually pay, but rather a figure used by colleges and the government to assess your financial need and determine your eligibility for various types of financial aid programs. The EFC calculation considers 4 primary factors. First is family income, which includes both parent and student earnings. Second, the formula examines assets and savings, such as bank accounts and investments. Third, family size matters because larger families typically have more expenses to manage. Finally, the number of family members currently enrolled in college is considered, since having multiple students in school simultaneously increases the family's financial burden. Each of these factors is weighted differently in the final calculation. Income assessment is the most significant component of the EFC calculation. The parent's adjusted gross income serves as the primary factor in this evaluation. Student income is also counted, but typically at a higher rate than parent income. The formula does provide income protection allowances, which reduce the amount of income subject to the EFC assessment. These allowances recognize that families need to maintain basic living expenses and cannot devote all income to college costs. Not all family assets are treated equally in the EFC formula. Counted assets include savings accounts, investment accounts, and equity in real estate beyond your primary home. However, certain assets receive protection. Your primary residence is not counted toward EFC retirement accounts like 401k plans, and IRAs are also excluded. Additionally, equity in small businesses owned by the family is protected from the calculation. This distinction encourages families to save for both retirement and education. Different types of income and assets are assessed at varying rates. Parent income is assessed on a sliding scale ranging from 22% to 47%, depending on income level. Parent assets are counted at a maximum rate of 5.64%. Student income faces a higher assessment rate of 50% above a small income protection allowance. Student assets are assessed at 20%. These higher rates for student resources reflect the expectation that students will contribute more proportionally to their own education. Understanding how EFC determines financial aid eligibility is straightforward. Colleges subtract your EFC from their total cost of attendance to calculate your financial need. For example, if a college costs $50,000 per year and your EFC is $15,000, your demonstrated financial need equals $35,000. This financial need figure determines how much need-based aid you qualify to receive, including federal grants, work-study programs, and subsidized loans. Let's walk through a practical example. Suppose a college has a total cost of attendance of $50,000 per year, which includes tuition, fees, room, board, and other expenses. Your family's calculated EFC comes out to $15,000 based on the federal formula. Subtracting the EFC from the cost of attendance gives you a financial need of $35,000. This $35,000 need represents the maximum amount of need-based financial aid the college could offer you through various programs. Families can employ several legal strategies to potentially reduce their EFC. First, maximize contributions to retirement accounts, since these are protected from the calculation. Second, carefully consider asset ownership, as holding investments in parent names rather than student names results in lower assessment rates. Third, timing matters. Strategically plan when to realize capital gains or make large purchases. Finally, consider 529 college savings plans, which receive favorable treatment in the EFC formula. Planning ahead can make a significant difference in aid eligibility. Let's review the essential points about expected family contribution. EFC is calculated using a federal methodology based on your family's financial situation, including income, assets, family size, and the number of children in college. A lower EFC means higher eligibility for need-based financial aid programs. Families can use strategic financial planning to potentially reduce their EFC within legal guidelines. Most importantly, understanding how EFC works empowers families to plan realistically for college costs and maximize available financial aid opportunities. Knowledge of the EFC system is an essential tool in making higher education affordable.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.